Good afternoon, everyone. Welcome to today's Wednesday market review. My name is Stock Darts, and we're going to do what we always do on Wednesdays. We're going to go ahead and take a look at the four major market indices. We're going to look at the S&P 500, the Nasdaq Composite, the Dow Jones, and the Russell 2000. Once we finish looking at those and analyzing what kind of price environment we are currently in the markets, we'll also take a quick look at the U.S. dollar. We'll look at a couple commodities like gold and silver and some oil. And then we'll also look at Bitcoin and Ethereum, and then move on to chart requests. If anyone in here has a chart request, feel free to type it into the chat. I'd be more than happy to go ahead and take a look at your chart once we review the markets. If you like what you see here and you like the way I analyze stocks or charts, you can always find me at Twitter under the name Stock Darts. You can find these videos at YouTube under the same name, or you can visit me at patreon.com/StockDarts, where I post weekly blog content including trade ideas, watch list ideas, as well as putting the recordings of these Wednesday market streams in there as well, along with anything else I have. It's my blog, and it's where I typically have my most content. So if you like what you see here, if you like the way I look at charts, that's usually the best place to look. If you're watching this as a recording and you want a chart that you have a chart that you want me to look at, feel free to message me on Twitter, and I'll be more than happy to go ahead and give you my take on your chart or whatever question it is you want answered. I can go ahead and try to answer that for you. Other than that, let's go ahead and get started. The first thing we're going to do is take a look at the S&P 500. And we're going to do that through the ETF SPY. Now, as you can see, we are pretty close to all-time highs. We've had a couple of days of red price action, but we really haven't gone anywhere. And in all honesty, the market environment hasn't changed in about a month now. We've been basically peaking out towards new highs since way back here in July, as we started to break out from the previous range of consolidation. And we've just been hovering above highs and slowly trying to make our way upwards. Now, I think the big thing to take from this is that the sellers have had absolutely no ability to push down the market over the last month or so. And in reality, they haven't had much success pushing the market down since probably November of last year. However, we have had some areas, some nice little corrections within the context of our larger term time trend. As you can see, since back in November, right as we started entering the holiday season, we've had a very nice and steady trend on the S&P 500. And despite the fact that we have had some periods of decent consolidation and decent price correction, for the most part, it's done so mostly through time by trading sideways, with most of the downward price action being contained within this rising channel. And recently, we've been starting to, like I said, stall out as we start to push to new highs and slowly kind of just drift sideways, creating just another one of these stair steps in the series of stair steps that we've had over the last several months. Now, the one thing I will point out here is that this is a little bit different from what we've been seeing, in that typically we've been getting volatility to increase as we consolidate sideways, and then it decreases as we rise up. And then you can see, you just take a look at the size of the candles, right, and look at the rectangles. Most of the candles inside these rectangles are kind of big, and as we start to finally make our way upwards, they start to shrink in size. And then as we start to drift sideways, they again get bigger, and eventually shrink in size as we start to drift upwards. Now, if you notice, this most recent time, the candles did shrink, but we didn't really get too much of a rise, and we just did. And as you can see, with the last 2 or 3 days, volatility is starting to increase. The way this pattern has played out over the course of the last several months is that when volatility has increased, it has typically meant that we are going to drop in price, or we're going to start to consolidate even further. The fact that we were not able to really push very high on this recent trend upwards is a warning sign that there's a decent chance that the market is going to have to sell further and hit newer levels of support before we're ready to move forward. Now, that's a little bit of a warning that we might pull back. However, that's not a warning that the market is topping out. That's not a warning that we're entering some kind of serious price correction. This market, I think, until it proves itself otherwise, we have to assume that it's going to continue climbing upwards, and really nothing has changed from a larger environment perspective to say that the market all of a sudden has reached the end of its rally, or that we're ready to top out. So I'm not saying that we need to panic or we need to start closing out positions or anything of that nature. I'm just saying, if you are looking to trade right now, you need to be careful, because we are starting to see signs of a market that is not able to push higher. Typically, when it caves in, it starts to head down and hit some support levels, which is it's actually what it's done over the last couple of days. And the key here is now, was the 20-day moving average enough, or do we need to head down and test the 50? And I think obviously the jury's not out yet, but I think there's a good chance that we do head down and test either the 50 or at least on the S&P 500, maybe this channel, maybe the bottom of the channel. But my guess is typically in a strong trend like this, you typically go ahead and test the 50-day moving average and not necessarily worry too much about the channel. Now, one other sign that I think is showing that things are starting to change a bit from what we've seen in the last 2 or 3 weeks is the volume. As we were drifting sideways and trying to make our way upwards, volume was actually decreasing. And we finally had a big bump in volume on Monday. Now, you look at this and say, well, we broke out to new highs on Monday with volume increase. That's a positive sign, right? And volume, of course, is a little bit trickier to analyze because it's really more a measurement of overall excitement in the markets, usually. And the fact that it did climb up is usually good on a breakout. However, Monday was not a clean breakout. We actually started the day off selling off, and we rallied at the end of the day to make it look a lot better. And if you look at it, it's basically a small hammer candle. You don't want to normally print hammer candles at highs. Usually when you print a hammer at a high, that means that sellers are starting to take control. Even if they're not able to hold it throughout the day, they're starting to emerge and they're starting to push down the price action when we're starting to encounter supply. And that's really what happened here. We had a big surge in volume, but half of that was really when the market was kind of pulling down. And then the next day we again had another small hammer. I'll zoom in. You can see we had a hammer here with a nice wick down to the 20-day moving average. Again, an even higher volume, showing that we're starting to get a little bit of a battle going between the bears and the bulls. Now, on the bright side, the buyers, or the bulls, however you want to define it, they keep defending our current price area, and we keep closing upwards. So the sellers are still having a hard time really being able to push the price action down. And part of the reason that I say you don't want to get kind of nervous here and necessarily sell out of the market is that the buyers could continue to keep pushing the bears out of the way, and we start to rally right back towards new highs. After all, we are testing the 20-day moving average, and there's a decent chance that we hold here and we push upwards. So it's not the end of the world here. I'm not saying that these are definitive signs that we're ready to pull back. However, they are warning signs. And when you see a warning sign like that, the first thing you want to do is just be a little bit more cautious about how you go ahead and enter trades. So what I'm doing is being a lot more careful about how I'm going to go ahead and navigate my trades over the next week or two until we see what happens next. As it is, I've already been kind of cautious because we weren't really able to push through to new highs with any kind of real strength. And as you start to drift upwards like this, the risk reward just gets worse and worse. And so it hasn't really been that great of a trade environment, despite the fact that the indices are at all-time highs and are basically holding at them. You know, as a trader, you always want to make sure that you remain disciplined and you don't let the market sort of trick you into getting into the wrong styles of trades. And markets like this, what we've seen over the last couple of weeks where we just have no movement whatsoever on the indices, it kind of lets you, it kind of lulls you into a sense of complacency where you feel like, well, the market's not going to go down, so I could just enter a stock. And you might enter a stock that's up 6 days in a row, and then what ends up happening is you get shaken out. Even if it's not a substantial correction, even if it's not a major change in the what that stock is doing, it's enough of a move in price to shake you out and take you out of it, even though you might have been right in the long term on what that stock was going to do. So you want to make sure that you don't let the market kind of fool you here, and you start chasing the price action because you start to get emboldened by the fact that the bears have not been able to really do anything. If you look, the last time we actually had a little bit of a drift upwards, we did have a quick shakedown, and you can see we've had these shakedowns several times throughout the last 6 months or so, and each time it's been met by buyers, and each time the overall trend never changed. However, for traders that are trying to hold positions, it's very difficult to hold through these big drops, and what ends up happening is you cave in and you exit your trade, and then the market resumes without you. And so what we want to make sure is that we don't put ourselves in a situation where we let the market shake us out because we get in at the wrong times. So that's, I think, the key is to be careful with what we're seeing out of the market right now and making sure that we don't let it fool us. Give me 1 second. All right, sorry about that. And so, looking at what we're seeing here on the S&P 500, as I said, I'm starting to see signs of an inability to move to new highs, which of course means the next step is probably to go ahead and see where the new lows are going to be. Now, the new lows could end up being right where we are now at the 20-day. More likely than not, we will head a little bit more down and maybe retest this 438 level, maybe test this ascending channel, maybe wait for the 50-day to come up and meet the price. If you're looking at key levels to watch as far as what happens if we do continue to sell off, well, I just outlined them for you. The first major level is going to be 438, and the next level is going to be the 50-day wherever we come up to meet price. Now, of course, it could be that we are already at the level, like I said, and that we're not going to really go further down below 441. But decent chance if we do continue to sell, we're going to come down at the very least test this 438. As you can see, that was the ceiling from their last range that we spent stair-stepping. I think that this rally is getting very long in the tooth, and I think there's a very good chance that we're going to break this channel probably before the end of the month. And if that's the case, then we're going to clearly have to come down and test the 50 and maybe even below that. Now, the major level of support that I do not expect to be breached is 422. And what I mean by that is I don't expect this to be breached within the next pullback or next even two pullbacks. Like, let's say we kind of break down and we head down to the 50, then we bounce up, and then we fall even further. I still think that we likely hold at 422 as a key level. And if we lose this channel, I think that's probably going to be the area that ends up being a temporary floor as we go ahead and try to figure out what's going to happen next. Now, even though I'm looking basically downwards as what I expect to happen over the next 2 weeks or 3 weeks, there is, of course, the possibility, and it's a pretty strong possibility, that this trend continues. And if it does so, well, I mean, it's pretty clear. At that point, we just continue to ride the price action. We continue to buy stocks that are giving us good entries. And if that's going to happen, what we're going to see, of course, is either we find support at the 20 or we find support at one of those two levels I pointed out. And when we see reversal candles, we go ahead and we enter. And we just ride the mountain, we ride this wave or whatever you want to call it right back up and continue climbing higher and higher. The big thing, like I said, is we don't want to let the market fool us into chasing price action. Now, that's not necessarily the case with the last 2 days, as we have had a little bit of a pullback, but prior to that, we had 1, 2, 3, 4, 5, 6, 7, 8, 9. Out of the last 10 candles, maybe 2 were red, and even those still had kind of positive price action. And anyone that entered on Monday's high volume close, they kind of got left holding the bag as we pull back over the next 2 days, as they were the ones that kind of got caught chasing as we kind of turned around and fooled traders. And that's what the market likes to do, and that's how it typically gets money back into its pockets, is by fooling the weaker hands to jump in at the wrong time, and then we correct, and then the stronger hands go ahead and buy. And I think we're reaching a point where money wants to come back to the stronger hands, which means comes back to value, which is where we want to be waiting to go ahead and take advantage of it. Now, one thing I do want to point out, and this is something we discussed last week in good detail, is that right now, when a market is behaving the way it is, where the indices themselves are holding steady but they're not really going anywhere, underneath the surface there's a lot of different areas of the market that are moving up and down. And I think that that's still the case, and I think that if you are wondering, well, what am I supposed to do with a market like this where you're telling me there's a decent chance we pull back, but there's a chance that we rally and we're kind of stuck in the middle? Well, what you want to do is you want to find areas of the market that are either ahead or below the curve when it comes to this, right? So you want stocks that have already pulled back after failing to break out higher, or you want stocks that have already pulled back and are starting to break out and are emerging from good periods of consolidation. And that's one thing that I've noticed over this last 6 months or so, is there's been some pretty clear rotation going on back and forth between different areas of the market. And if you're able to kind of seesaw back and forth between those, you've been able to do well despite the market sometimes being stagnant for weeks at a time. And so I think that that's really been the trend for the year so far, has been making sure that it's trying to catch these different market fluctuations as different areas go ahead and start to do better and outperform while others begin to underperform. And I think that that's still going to be the key going forward until we see a different type of environment than what we're seeing right now. Looking at the S&P 500, things look pretty good, and they're going to look pretty good as we look at the Nasdaq and the Dow. But when we get to IWM, you'll see that there is some disparities coming into the markets, and there is a little bit of disagreement between different areas, and that's kind of forcing these markets to kind of chop back and forth. So, like I said, as far as the S&P, I think right now the S&P 500 gives us the best picture of what the overall market is doing. And as you can see, I mean, it's positive. I know I'm sounding more negative today than maybe I have over the last couple of weeks, but that's really just short-term negativity. I think in the midterm to long-term, everything is still very, very nice and very healthy, and we're still in a pretty bullish market. And I think even if we break this channel and we come down and we head down to 422, I think that's still in the long term. If you take a look, we're going to go to the weekly real quick. You can see we're still in a very, very strong market. It is a market that, as you can see, is probably starting to reach a point where it needs to go sideways or even correct further in price. But right now, it's just continuing to just trend upwards. And as long as it does so, like I said, we don't want to get too nervous, but we also don't want to get complacent and start to take poor trades because we think the market will continue to just kind of climb without us. You want to make sure that you are still remaining disciplined and following the right entry rules that you have set in place as far as whatever your trading style is. Now, if we go to the Nasdaq, you take a look at the QQQ, you can see this is actually a pretty different picture from what we just saw in the S&P 500. Overall, it's still pretty bullish. We're just consolidating near all-time highs. We're still in the midst of what was a pretty decent rally. You can see, however, unlike the S&P 500, we don't have a clean channel that we can say, well, we've been in a steady uptrend since way back in November. If we go ahead and scroll back to November, you can see that the Nasdaq has had some different styles of fluctuations. We had the nice channel that we broke down. We had a nice little consolidation sideways to really shake out traders. And this is what eventually will happen with the S&P 500, is eventually that channel is going to break. And the quick drop is going to fool a lot of traders into caving in, when in reality it's probably going to just be a sideways consolidation as we find what the next value. Now, of course, we always have to be careful of this because eventually one of these periods of consolidation, one of these corrections is going to be a much bigger one. But until that happens, we can safely assume that more likely than not, buyers are going to step in and support these. And so what you want to do, as always, is make sure you're waiting for reversal signals and you don't panic out of too much. Now, we have stops, right? That's when you're managing a trade, you always have a stop in place. And if something breaks down, you stop out, right? However, what I find a lot of traders do is they stop out and then they never get back in because they're in a panic that this is going to continue to head south. And what you want to do is you wait for the drop, you wait for consolidation, you wait for a reversal pattern, you go ahead and enter. Now, going back to May and April of this year, I'm not saying you enter here at the bottom, but maybe you wait for this pattern to play out and you wait for this channel to develop and then you see when the bulls finally take control, and maybe you enter here at 315. Yeah, you didn't catch the entire bottom, but you waited for it to shake out and you waited to see where your entry signal was, and then you go ahead and start to ride the rally right back up. The key is, a lot of times I discuss this, especially with traders that I've mentored in the past. They tell you, oh man, well, I missed this stock. I can't wait till it comes back to X price, and then I'll go ahead and enter. Whether it's the market, whether it's a particular stock. And so what ends up happening is eventually you do correct and you get to that price that they wanted, and then they're like, well, I don't want it anymore. And then they let it go right back without them. And invariably what happens is they chase it when it's at the highs. And that's what the market does to traders, and that's how it always fools you into entering at the inopportune times. And so what you want to do when you have a market like we have now is you don't want to be the one that feels like you missed an entire move and you start to chase it at the wrong time. You want to wait for the market to prove itself, and you want to wait for the right entries. Right now, if we were just looking at the Nasdaq as a stock to enter, this is not where you want to enter. Now, I'm not saying this is a bearish place to be. It's not. It's just stuck in the middle of a little triangle pattern as it consolidates. However, at this point, there is just as much likelihood that it breaks the bottom of this as it does to break the top of this. And so, if you're entering a trade right now on the Nasdaq, you're just flipping a coin. What you want to do is you want to wait for a breakout if you're a momentum style of trader, or you want to wait for it to pull back and give you a different type of consolidation range to go ahead and trade. Now, what I was getting into before I got sidetracked there with the whole pullback and what happens when we break these channels is if you compare the Nasdaq to what the S&P 500 is doing, you can see it's a pretty different picture, right? If we go back to the S&P, you can see that we are breaking to new highs and we're consolidating at the highs. We're consolidating above previous resistance, while with the Nasdaq, we're kind of mired in a correction range. Even if it's a tight one, even if it's a very narrow one. Now you'll notice volume very similar. We had a spike in volume on Monday with a hammer candle, which is typically not a good sign. And then yesterday we had an even bigger spike in volume with the doji. Now these aren't major spikes compared to what we've seen in the past. However, it is an increase compared to what we were seeing prior to that as we just drifted sideways. This right here is a good picture of what I meant before about rotation. Right now, tech stocks are not quite as strong as the S&P 500 components. Now, it's not a big difference, right? Because we're still pretty close to all-time highs. We're not above what we just recently traded at. And we're below the 20-day, right? So there is some weakness emerging here in the tech stocks, which could be seen as capital rotating out of tech. Now, is this a longer-term rotation back out, or is it a shorter term? One of the things that has kind of defined trading this year has been the rotation in and out of tech. And this is something that if you were able to catch it well, you would have done really well for yourself as far as getting in and out of tech names at the right time. Throughout 2020, a lot of tech names did extremely well because they benefited from traders working at home. Those of you that are regulars, you'll know this is something we've been harping on for more than a year now. As we started to get more and more of our population vaccinated, we started to look forward towards reopening and recovery, right? And so we looked at recovery stocks that were hit hard in 2020, and money started to rotate out of the tech names that benefited from us staying quarantined. And so money rotated out of tech. That's why the Nasdaq broke down from this channel, while maybe the S&P 500 or the Dow continue to climb upwards. And so we've had these big ebbs and flows in tech as money has rotated out. Maybe it got a little oversold. Then it kind of rotated back in, and then rotated out as we maybe started to go back into recovery, rotated back in, and now we're at a spot here where is money going to rotate right back out of tech, or are there enough fears in the resurgence in what we're seeing in COVID, where this is just a temporary profit-taking move, and then tech stocks are going to continue to ramp up, right? And so that's the decisions we have to make as traders, particularly when a market is kind of stuck in neutral. And not really breaking out, but not really breaking down, is you want to figure out, well, there will be pockets that go up and down, even if the market does not. And that's one of the areas that we need to kind of pay attention to and keep an eye on. Now, I have kept looking at tech stocks, and I have recommended a few tech trades over the last couple of weeks. For now, they have not been working, but they haven't actually given us an entry because they're not working. And that's one of the keys, is making sure that you don't enter in these triangles. You wait for the price to emerge out of these triangles, at which point then you know the momentum is back in, right? So, as an example, I'll give you guys a window into what we were looking at this week. One of the trades we were looking at was Amazon, right? And what we were looking at was the fact that it had already pulled back. I mentioned on Monday that there's a decent chance the market is going to pull back this week, but if it does, maybe we catch a name like Amazon that had already pulled back prior to that and tries to lead the way back up, right? And so we were looking at it. However, what we were watching was, you could see price action was getting wedged between the 200-day moving average and this descending trend line, and it had reached a spot that was really looking like it was worth buying. However, it never gave us our entry signal, right? Because it never actually broke out of this descending trend. What we needed was on Tuesday for it to break past Monday's close and to stay above the 200 and to stay above this. And as you can see, it failed. So we never got an entry signal, so we never actually had to trade this. And that's one of the keys is when you're looking to trade, you don't just buy blindly because it hits a level you want. You still wait for it to prove itself. And for now, Amazon has not proven itself, and as a matter of fact, it's headed even further down, and it's now trading below the 200. So if I'm still looking at tech as an area to rebound, and I'm still looking at Amazon, well, what am I looking for to do next? Well, now it has to do two things, right? Because it still needs to break this descending trend line, but at this point, it needs to get back above the 200-day moving average. So, I would be looking for it to actually try to get back above 32.75, and then when it does start to get above that, then we got to figure out risk reward. Is it going to be worth it? If we have, what is that, maybe 80 points of downside, are we going to have at least 160 points of upside in order to make it worth our while, right? So there's a lot that goes into trying to make a trade. It's not just a matter of thinking a stock's going to go up or down. And in this particular case, this is a stock that did not work out for us, but we didn't lose anything because we never entered it, because it never met the criteria that we were looking for to enter a trade. And that's one of the ways that you make sure that you keep yourself in very high probability structured styles of trades, is by forcing a stock to prove itself before you go ahead and enter. So to go back to the Nasdaq and the Qs, like I said, I still think that there are tech names that are going to bounce, and I don't think that this is the beginning of a major correction in tech where we head back and start another one of these broad consolidation ranges while the S&P 500 or the Dow rally upwards. I think that this is, at the moment, in my mind, a more narrow consolidation and more profit-taking, or more just people waiting to see what happens next rather than rotating out. I could be wrong, which is why I always wait for the stock to prove itself before I enter. But we'll see what happens next with it. But looking at the Nasdaq and what we can expect if we go up or down, right? If we go down, well, we break down below the 20-day moving average, which we already did, and we break below this channel, we probably head below this very short-term 362 level, and we probably head down and test the 50. And I think we test it pretty quickly. So if we fall back below today and yesterday's lows, I think we head straight down to the 50 and try to find support there. I think we likely do, and we bounce right back up and just chop between the 20 and the 50. And then from there, the market figures out whether it wants to make its way back up to new highs or whether it needs to come down and explore further. Now, just like the S&P 500, we have a lower level down here, this that I have outlined with this green line, around 342. I don't expect us to break this on the first pass or probably even the second pass. I would consider this to be a strong buying area. Now, as I just pointed out when we were looking at Amazon, just because the Qs hit this doesn't mean I'm going to buy immediately. I will still wait to see a reversal pattern of some sort, or buyers sort of showing up. But this would be a really good buying opportunity, or good buy the dip opportunity, if the right scenarios arise on a move down. Now, that's a pretty big drop. I don't expect that drop to happen right away. Like I said, I think that there's still a pretty good chance that we actually just bounce from here and rally to new highs. And if we do pull back, I think it's a very shallow pullback to 50. But you want to be prepared as a trader. You want to make sure you have all your levels ready. So if we do lose the 50, we probably head down to 352. And then from there, it would become all the way down to 342. And like I said, I don't expect 342 to be an area that we lose anytime soon. I think this will be a major level of support. But I don't think we even get there right away. I think that we would chop and kind of dilly-dally back and forth. I think we're through our most recent Fed statement. We're through most of the meat of earnings season. So there's not a lot of catalysts here to really shake the market down. We've already kind of seen a lot of bad news coming from not only the COVID situation, but even what we're seeing with Afghanistan. And I mean, that's not going to really affect us from our economy perspective, but sometimes bad news like that just scares people. And really, we're not seeing that. What we're just seeing is the market kind of stall out. And I think it's doing that based completely off of technicals, so we don't really need to worry too much Right now, it doesn't seem like news is affecting the market, which means it's going to really just trade off technicals, which means more likely than not, the averages and the trend lines or whatever we have in place are going to hold, or at the very least, give us support for a temporary time. Which means that if we do pull back, expect the 50 to probably hold, and we bounce right back and test the 20 again. Now, on the other side of this coin, if we get back above the 20, we get back above today's highs, then there's a decent chance we get back above 370 and we break out. And if that's the case, then we should see some of these tech names that have pulled back start to bounce. And if that's the case, there's a lot of room for profit in some of those scenarios. Something like that Amazon chart. There's a lot of upside if the market does indeed start to rally again. So I would keep an eye on those if I were you. Now, another different picture, of course, is the Dow. Now, the Dow is a lot more like the S&P 500. It actually broke out, and it's kind of holding above highs. Now, we are, again, still at a pretty important spot here. If you go ahead and zoom out, you take a look at what has gone on with the Dow Jones, and you can see it's actually an amazing picture of a channel that has somehow remained intact despite not remaining intact, if that makes any sense. You can see we had a channel, much like the S&P 500 and the Nasdaq, that developed back during the holiday season last year. Now, right around, well, at the turn of the year, and once again around March, we actually threatened to break down below that channel. I actually spent a couple of days below it. This was when the tech names, money was rotating into tech and out of recovery, and it was pretty clear that the Dow was struggling. However, the Dow was able to recover and actually started to take off as tech started to break down, as money rotated into recovery stocks and out of tech. And this is what I was telling you before. One of the key things to watch, and one of the ways that we've seen an interplay as capital rotates in and out, has been the back and forth between recovery and tech. Now, at this point, this is when this channel starts to really kind of lose a little bit of its value for us, because we started to trade above it, we started to expand, and then we reached the spot here on the 10th of May where we kind of topped out, right? And then we entered this broad consolidation that really just kind of pushed this channel to its limits as far as what we could consider. Now, this one trend line, the support trend line, mostly held, and just like the last two times, we had a couple of dips below it, and some traders would even go ahead and just extend the new trend line. Now, I'm not normally a fan of that. I don't have a problem with trend lines being breached. I think sometimes it tells us more when we see that the previous trend line was broken and then it comes back and is kind of respected again. However, you could just put a new trend line on here for the breaks, and you can see that there is room for us to eventually break down again and maybe still hold that upwards trajectory, but we're not going to keep that there. I think that the original trend line is more significant, even though we've had it breached a few times. And now the thing here is, right now we emerge from this consolidation range. We have a pretty bullish alignment on the Dow Jones when you look at the moving averages, and we have a bullish alignment in that we have a big consolidation range that we just broke out of, and we are coming back and retesting. So unlike the Nasdaq that actually looks like it needs to consolidate further, or the S&P 500, which is kind of stuck in neutral, with the Dow we have a spot here where it's kind of do or die time, right? It broke out, it came back and retested. It's retesting this really long trend line that is held intact for the most part. It's holding the 20-day moving average, and it's above it, right? So this is typically where you retest and then you take off. You also have the 20 moving average moving up. You have the 50 underneath it starting to spread out. This is all a pretty bullish alignment. However, if we fall below these technicals, then it becomes a pretty bearish alignment, at least in the short term. And it means that we had to come all the way back down and probably test down to the 337 area. So I think that this is actually one of the indices that we want to watch to see what happens, because this is the most, I think this is the biggest crossroads here as far as what could be bullish or bearish depending on what happens over the next few days, on whether this breakout holds or not. So this is one of the spots we want to watch. Now, This would lead us to believe that money is rotating back into some recovery names. The Dow has been kind of synonymous with the recovery trade uh, over the last year. And so this is leading us to believe that maybe money will stay out of tech and rotate back into the Dow. Personally, I think that if the Dow rallies, I think tech will rally with it, which is why I'm still watching some tech names. But this is a sign that some recovery names are starting to pick up steam again, despite what we're seeing on the news. And so we want to watch here is, will the Dow Jones break above or break out from this recent support area and start to make its way back to highs? I think that this is one of the easy ones for us to tell what's going to happen next. If we fall back below this green trend line, we fall back below the 20, we head right back into this area. Well, we have to assume for the moment that the stock market is stuck in neutral, and that means that more likely than not further correction. If it can actually get back above it, now it could be just like the last several times, we spend 2 candles below this trend line and then get right back above it. But until we get above this, assuming we break down, until we get back above the trend line, I would imagine that we need to be more careful. Now, like I said, if we find buyers and we immediately break out, then I expect that that would bode well for the S&P 500 and the Nasdaq as well. So the key levels we want to watch, the major level is right where we are right now, right with the 350 area, 351, with this ascending trend line in the 20. If we break below that, the 50-day becomes the very short-term stopgap, where maybe we get a shakeout. But if we break below the 50, we're probably going to head all the way back down to 337. At that point, I think we'll see it pretty clearly across the board, and that's when we start to look at maybe waiting for some buy the dip names, and maybe waiting for a different style of trade than what we've been doing recently. All right, so that's what I have to say about the Dow. I think that as far as the 3 that we've seen so far, this is the most significant price action we need to see develop clearly. I think with the S&P 500 and the Nasdaq, there's more room to go back and forth. As you can see with the SPY, we have room to pull back and still remain within our trend and still remain in the same bullish or same environment. Same with the Nasdaq. There's room to go up or down, and we could still, even if we break this short-term trend line, there's room to go up or down, and the Nasdaq still remains in its same type of price environment. However, with the Dow, a move down changes dramatically what we would consider the definition of this price environment, because we would no longer be consolidating above the previous range. We'd actually be down here in the wrong area of the recent consolidation range. So this one is, I think, the one that has the most importance as to what happens next. So it should be one of the indices that we pay more attention to. Now, the last index we want to look at is the Russell 2000 IWM, and as you can see, a completely different picture from what we saw with the Dow and with the Nasdaq and even the S&P 500. The small caps have been stuck. They've been trading sideways. You can see the moving averages crisscrossing back and forth like spaghetti. Nothing really bullish going on here. We had an attempt to kind of consolidate and push back to the highs, and we failed. We came back and we tested to 200 over the last couple of days. This is part of what is holding the markets back. I want to say more, this is a symptom of what's holding the markets back. And that is that there's still some fear underlying, and there's still traders that have not really held on to the confidence that we had at the start of the year. And if you think about it, the small caps are the most volatile of the 4 indices as far as the types of assets that are included in it, right? They're the smaller cap names. They're typically more volatile, and they're typically what you would consider less quote-unquote safe than maybe a big tech name or a big S&P 500 or Dow name. And so when you see a lack of bullishness in them, that tells you that traders are looking for safety rather than looking for aggressively looking for gains. Now, that's not always exactly how it happens, and truth be told, throughout the last decade, there have been plenty of times when we've rallied strongly and IWM has participated a lot less than the other indices, and so there's a chance that that continues. However, I still consider this to be a symptom of a certain degree of fear that is in the market that maybe is not seen when we look at the 4 major or the 3 other moving average, the 3 other market indices. And so, for now, we have to assume that if IWM is still kind of stuck in neutral, it probably means that we're not going to see a full-fledged breakout with the other three indices. And we're probably going to continue to see this rotation game back and forth as we kind of just go up and down and maybe, make new highs and stair step, but not anything definitive and not anything as strong as what we saw last year at the close of the year, right? When all four indices move together, you get stuff like this. When they don't, you get stuff like this, right? And so when you have a market like this, like I said before, I think the biggest thing you could take away from it is you want to figure out where capital is rotating. The market is not going anywhere, but different areas of the market are. And so that's how you want to go ahead and do it. Now, let's take another aside. And I'm going to show you again. Those of you that are here are probably regulars. You've probably seen me point this out before. But you go ahead and you go to FinViz, right? This is another free site that you could use. You don't have any kind of subscription or anything. You don't need to. If you come over here and you look at your groups, you can get an idea of what areas of the market are doing better or poorly depending on the time frame, right? So today we've got consumer cyclical doing good. This is typically, again, you usually see consumer cyclicals doing good when the market is nervous. You can see basic materials, real estate down, utility down. This is part of what I would consider the recovery trade. So not really looking good as far as today is concerned. You look over the last week, healthcare is doing well. Everything else doing poorly. Over the last month, you can see financial and healthcare. So healthcare was one of the areas that has done really well recently, as one of the ones that money rotated into. And so we've reached the point where it's probably done well for a while. So we have to start to think, will it rotate out? And if it does, which one of these areas has done poorly? And we could keep an eye on, right? So you take a look. Well, look what we've got here. Consumer cyclical, down for the half year. Kind of neutral over 3 months. Over the last month it was down, and then today it's up, right? And even down here it's down, right? So down for the week, down for the month, neutral for 3, down for 6, right? Start to do better today. So maybe we go to our screener. We look at consumer cyclicals. Now again, there's 530 consumer cyclicals, so we want to do more. But maybe we go ahead and we do something like we scan for volume, right? We want something maybe with over 400K volume. Now we've got 318 names to look at. From there we can look at anything else we want. Maybe we want a stock that's over a certain price, right? Maybe we want something, let's go to all here. Maybe we want something that's over $5 or over $10. You break it down and you keep whittling it down by looking at different things until you get to a spot where you like what you're seeing. And then you look for stocks that you're happy with, right? Or you can just not even put any of that stuff and you just go ahead and look through all 500 charts. It sounds like a lot of work, but if you're trying to make money, you do as much work as you need in order to get to the stocks that you want to look at, right? And ideally what we're looking for here is, again, we're looking for that pattern. We're looking for stocks that were down over the last half year, down over the last 3 or 4 months, but starting to pick up and up over the last week. And look at that, Amazon, one of them. Maybe something like auto parts here in Ireland, advanced auto parts. You start to see a couple of these. Maybe you want to go ahead and pay attention. And then you go in and you just go. So let's say we wanted advanced auto parts. We go in here, we take a look, we'd see where it stands. Now this I don't think this hasn't been hit as hard as maybe some of the other ones. So it's not something we need to, necessarily trade, but you want to go ahead and dig in. Also keep an eye out, 6 days. Some stocks are still reporting earnings, so that's still something to keep an eye on. But what we'd want to do from here is we'd want to go ahead and we'd keep an eye out and we'd just go from page to page looking for consumer cyclicals. And what we want to see is, one, is there a trend that we're seeing across the board that matches what we just saw on the groups page, right? Are we seeing some consumer cyclicals starting to find the possibility of bouncing and to find the possibility of changing what we're seeing, right? So Bed Bath & Body Works, another one, right? Or sorry, Bath & Body Works. Um, did they changed their name, didn't they? All right, so I'm not sure why the I think they changed their name, or I guess maybe they merged or something. They report earnings anyway, but we'd want to watch, and we'd want to see if this is an area that it could go ahead and bounce in, right? And so that's how you could go ahead and try to define different areas of the market that are showing strength and where the money could be rotating in or out of, right? You just keep going through until you find one that actually suits what you're looking. All right, so that's the four major market indices. I spent, I guess, a little bit more time on that than normal. So I'm going to go pretty quick over the US dollar. I don't think too many people are really interested in it anyway. But we'll look at it real quick. We'll look at some Forex pairs and we'll look at cryptos. Those of you that are in here, if you want something for me to look at, go ahead and type it in now so that I have an idea of how much time I need to allot after I look at this stuff, and then we'll go from there. But let me know if there's a chart request, or even a question on a chart that you want me to look at. So as we can see, the UUP index, the US dollar, is picking up strength again, and it's still doing a pretty good job of establishing a foothold above the previous range that it spent a good portion of time in, right? You can see here these rectangles. You can see what happened is it finally bottomed out around the 2420, tried a couple times to break out, and is trying again to break right back out. If we look at the Euro-US dollar cross, which is going to be the inverse of that, you can see that the opposite is happening for the Euro, where it topped out instead of bottoming out. And obviously the US dollar bottomed out in this scenario. The down is good for the US dollar in this chart. And as you can see, the US dollar has pushed and made some serious headway against the Euro as the Euro starts to break down. So I think that this is showing a pretty big shift in the US dollar. And showing some strength coming in. Now that could be a hint that eventually rates will rise again. So that might be something to watch, and that could be something that goes ahead and does impact the markets eventually. But right now, all it really means is the U.S. dollar has finally stopped dropping, and is starting to stabilize, and is starting to actually show a little bit of strength here. Now, if we look at the U.S. versus the yen, we see. And this is back to where up is good for the U.S. dollar. You can see the U.S. dollar has basically been stuck in neutral after it had a very strong surge against the yen. I think at this point it's kind of a tug of war between the two. You can see there's some pretty nice neutral ranges that are developing, and playing back and forth in these channels is probably a good idea. And then the last one we want to look at is the U.S. Canadian. And in this case, I think the U.S. dollar is finally also making headway versus the Canadian. You can see we had a very nice move up. This, again, was something we highlighted on these Wednesday streams. And I think that this was a major trade for anyone that went ahead and followed me on it. Starting to see, again, the U.S. dollar start to crack above the 200-day moving average and start to really just establish that it's bottoming out. Now, this, of course, is going to be strongly related to what's happening in oil. And as you can see, oil is threatening to break down. If it does so, that's going to mean more strength coming out of the U.S. versus the Canadian. This is actually a very important spot for oil. You can see that it's below a pretty key support level. Now, we have a kind of more, I guess, a more of a relevant short-term level, but I think not as significant. I think that this is kind of the last gap level that's developing just below that. But the key level here is really 66.80 or so. And we've already broken down below it again. This looks like oil really struggled and is probably going to have to come back and test the 200-day. If it can get back above the 66.80 or so area, then I think there's a good chance it makes its way right back up and tests this descending trend line, and continues to kind of flesh out this triangle that's forming. But there is a decent chance that it fails here at 65 and heads lower. The good thing with oil right now is that we have a very clear area to watch. Either it breaks back above 66.80 and goes up, or it breaks down below today's lows around 65 and heads down. Whatever it does one way or the other is going to affect the U.S. Canadian. It's also going to affect a lot of oil stocks. So this is something that we want to watch and see how it plays out. If we look at gold and silver, Interestingly enough, they actually rallied with the US dollar over the last week. Um, as I have said for almost a year straight now, I have no interest in trading them right now. I still don't have any interest in trading them. They are at pretty suppressed values compared to where they've been over the last 6 months. So if someone is looking at a value trade, they can go ahead and try to take a shot at it, maybe more with silver than gold. I personally have no interest in them. And a big reason for that is because I have much more interest in the cryptocurrency space right now, especially if you're looking at it. Typically for me, gold and silver are seen as inverse US dollar trades. And I have not had any interest in them really since I got more and more into cryptocurrencies. I consider Bitcoin to be a much better inverse dollar play because it's going to do well whether the dollar does well or not. So it's not really just a play off of the US dollar. And I still think that these are the future of maybe not necessarily all currencies, but they're still the future of a big chunk of our financial system. And the more and more we move forward, the more and more important Bitcoin and Ethereum are going to be with regards to how we go ahead and approach finance from now on. And so I don't think they're going away. I think they're only going to become more and more important. And as a trader, regardless, they give me much better volatility. And in all honesty, even cleaner moves. If you go ahead and you take a look at what Bitcoin has done, even with this extended correction, and this is a major drop, however, we still have trend lines that work, and it still has pretty easily defined movement, right? If you take a look, you compare that to what we've seen in GLD, and you see all the sloppy back and forth, and you see all these trend lines. There's a lot less rhyme and reason to what gold and silver are doing from a technical analysis perspective. These are not easy charts to trade, where something like Bitcoin is still giving us pretty easy to trade patterns. So this is still where I'd rather be. And like I said, right now, so if we look at Bitcoin, it made a major move. It was able to finally break above 40, which is a key level. And right now it's trying to break above 45 and get back into the 50s. There is a decent chance that we maybe head a little bit further south here and retest lower levels. But I think right now, nothing that it's done is negative. And I think overall we're seeing a lot more bullishness coming into the crypto space. The same thing with Ethereum. You take a look. We're going to go ahead and, oops, wrong trend line. You extend this trend line, you can see what's going on here, where we had the breakout above a pretty important range, and we're holding above it, and setting up for the next move upwards as this tries to make its way back to highs. Now, it could be that we head south a little bit, but we have our clear levels to watch. And I think overall, again, this is where you want to be. And these are the stocks, or these are the cryptos, these are the equities you want to be looking to trade right now, because you get much more movement out of them. You know, look at something like Cardano's up 12% just today after a shallow pullback. We have something like Matic that's up, maybe it's only 3%, but still setting up for a potential move of double-digit percent over the next week or so. And so these are kind of the areas that I'd rather be in right now, rather than messing around with gold and silver. It doesn't mean I don't want to trade stocks. I still trade stocks quite often. But like I said, as far as looking at a vehicle that's trading against the US dollar, I'd much prefer the cryptocurrency space over gold and silver. Okay? Alright, so that covers what I wanted to look at today. Like I said, those of you that are in here, if you have anything you want me to add, you want me to look at anything else, feel free to type it in. If not, we can go ahead and wrap it up. Anyone that's watching this as a recording, if you stuck around to the end, I appreciate it. I hope you like what you see. I hope you like the way I analyze charts. Usually these trend lines, to me, I know that it seems to some people like they're just someone connecting dots on a chart, but in reality these trend lines tell you what trader sentiment is, and they give you a good idea of what the market thinks about an equity. And I think that's what's important, is understanding that when you look at a chart, you're not just looking at it. So for instance, this isn't just a chart of what Bitcoin is. It's a value of what people think Bitcoin is worth. And it's important that when you trade, you understand you're going against other people's opinions. And these trend lines, these moving averages, what they tell us is they give us a good picture of what people are thinking. Okay? Ray, good to see you in here. Hopefully, I don't know what you did with oil, but hopefully you saw my thoughts on oil. You can see, if you were here last week, you would have known I warned you about oil last week as well. Hopefully, I hope you're still not holding those contracts. But you're asking me now about Walmart. You're looking at selling a bull call spread. So you're looking at selling the 150 and buying the 155 for credit about 210. You believe a pullback is due. All right, Ray. I'm not sure that you're doing this correctly, but so if you think a pullback is due, you wouldn't be selling the 150. You'd be buying the 150 and you'd be selling the 155. Even though you're getting less that way, what you're doing right now is anything below 150, you're going to go ahead and take a position on it. I'm not sure that's what you want to do. Actually, no, I'm sorry. No, I'm sorry. I think you do have it right. I'm sorry. You do have it right. Sorry, that's me. I got confused. Never mind. Yeah, because if it's under 150, then you'll be short, and you'll have the 155 to protect you. Never mind. I'm sorry. I'm wrong. You're correct. I was a little confused here. Okay. So it just had its earnings, right? Negative react. Well, not a negative, but a pretty neutral reaction. Um, okay, so there's only one. There's only one. I don't think I really have any kind of criticism of this trade. I think that you're fine here. My only criticism of the trade would be that I am not a fan of shorting anything right now. Just because we're still like I said, if we look at the S&P 500, right, and we take a look at where we are, right, and the more and more we zoom back, the more and more bullish it is, right? So my only real thing is right now I'm not shorting anything. Now that being said, I don't think that what you did here, this is a fine short. We have two really big wicks here. We had an earnings event. We had high volume on this, and it couldn't break out. So there is a pretty good chance this pulls back. So I don't I'm not going to say this is a bad trade. It's not. I like what you're doing here. Now the one thing is, well, I wish I could open up my Thinkorswim right now, but my computer wouldn't handle it. I'd like to model it out to look at it a little bit more, but I think this is fine. I think you're fine here. Hooked on phonics. You want to look at? All right, we'll look at that in a second. All right, Ray. Yeah, no, Ray. This looks fine. You have up to October on it, and you have your protection. I think this should work out for you fine. I think that there's a pretty good chance this is going to pull back down to the 140s, and you should be able to do okay with it. All right, so VISL technology. So now tell me something, Hooked on Phonics. We've got, well, what are you looking at here, or do you just want my opinion on it? Well, I'm going to go ahead and let me know if this is something you're looking to enter as a trade or if it's something you're already in. What we're going to do here is I'm going to go ahead and, I haven't looked at VISL. So first thing I want to do is look at a weekly chart and see what the long-term chart on this is. Not a very promising long-term chart, but a lot of volume coming in as it's gotten to these prices, right? So a lot of times with a stock like this that I'm not really familiar with, what I want to do is look at the long-term levels and get a better gauge on what it's doing, right? So first thing we have is a pretty good support here that we're not concerned with at the moment, but just above $1, right? And then we've got another key level here I'd say right around this level. And that's the level that we do need to concern ourselves with. Alright, so now we go back to the daily chart. And we go ahead and we take a look at what's happened here since then. I think at this one it's kind of hard. It's basically the 20-day moving average. Alright, so now we have an idea. So this is what VISL has done over the last 6 or 7 months or so, right? And as you can see, it's at a pretty good floor. This 190, just below $2, is kind of an important level. Just above $2 was kind of where it found some support last time, right? So now we have a good gauge of what we want out of this. So my question is, how aggressive or how conservative are you as a trader? If you are an aggressive trader, you could try to get in ahead of the curve by maybe buying, if it holds over the next couple of days, at this $1.93. If you're a conservative trader, then what you want to do is you want to wait for it to get here. Now granted, your risk reward is going to be much poorer once you get to this level, considering what our targets are, right? So if you're aggressive, you have to understand you could get in here, maybe off of another candle tomorrow that gets above $1.95 or so, with the understanding that there's a very good chance that it stalls out here as it gets back to 210 and then heads right back down and tests lower. So looking at something like this and how I would want to trade it, like I said, there's a couple of ways. One hammer candle is, to me, not enough for an entry. This is a very significant long-term level, so I think that it does hold here. The key is, when it bounces, is it going to stall out here? So what I'd do is I'd maybe wait for tomorrow, a candle above today, at which point we can enter a trade, knowing that we got to take some profits here at about 210 off, and then looking for the rest to maybe make it back to the 200 and the 50-day moving average, and then eventually maybe back to the threes. Now, if you're a very conservative trader, if this is something you want to trade longer term, then I'd probably wait for it to break above 210, at which point our real target is really going to be the $3 and maybe even $5, knowing that it could take months to get to that. That's not something that's going to happen anytime soon. Now, I think as far as what could happen over the next few weeks to next month, more likely than not, it's going to bounce up to here. It's going to come down a bit, and then it's going to come back up and try to get to the 50-day moving average. So the key right now is, what does it do when it comes up to this area and hits the 20? And then if it does, it'll come out and test the 50 if it continues to be bullish. So that would be the two. Like I said, there's two ways. The much riskier trade is to look for an entry either today into the close, or more, a better chance would be tomorrow if it holds tomorrow again. And then the safer entry and the much higher probability entry is to wait for it to get above this, but that would take probably another week or two to get to. And obviously at that point your risk reward is a completely different story because you have a much longer stop. Also, today's lows would be a good stopping point if you wanted to go ahead and enter tomorrow or at today's close. Like I said, today's close would be difficult because one green candle is usually not enough of a reversal pattern to say to go ahead and enter. Typically you want more than one. If it was me trading this, personally, I don't think I'd enter until I saw it get back above this. I tend to be a little bit more cautious about the types of trades that I take, and I prefer a little bit more certainty. So I usually want a stock to be out of these kinds of areas, right? I don't like it to be below support. I don't like it to be below the 200 and the 50 and the 20, because that's just a lot of overhead pressure that it's going to put on it, and it's going to make it a lot harder for a clean trade. I prefer when stocks get outside of this range and break out. Now, it doesn't always work out. For instance, to me, I would have entered here, and this trade would have worked out okay, but it wouldn't have been great because it turned around and reversed and came all the way back down. So even when you have the great entries, they don't always work out for you. But I prefer to have a clean entry where I know exactly where I'm going and what the key stop outs are. In this case, you have a lot more overhead pressure. However, I do think that there is a potential for bounce here. Like I said, if you look at the weekly chart, that is a pretty significant level. However, you can see there is an even more significant level much further below that. So there is opportunity for it to drop. So what I would say is, if you do take the trade, if you do take the gamble and get in early, make sure you stop out because there's a lot of room to the downside. Okay? Hope that helps. Thank you for coming in. I don't think I've seen your name before. Appreciate you watching. I hope you like what you see here. Typically, we do this every Wednesday, and I'm more than happy to look at any chart that traders have. All right. I think that covers it for today, unless you guys have anything else. If not, we can go ahead and wrap it up. I appreciate you guys coming in. I appreciate you guys participating. Have a good rest of the week, and we'll meet again next Wednesday.